Hello, everybody. My name is Jacek Bartosiak. Welcome to Strategy and Future. With me is my colleague, Director of Analysis, Świdziński. And of course, our special guest, our favorite guest, I might say, at least in my personal opinion, Louis-Vincent Gave, founding partner and Chief Executive Officer of Gavekal, extensively dealing with investment across the world, including the emerging markets. I hope that I introduced you properly. For those who know the markets, who like listening to smart people, Louis-Vincent Gave very often talks about investing, making money, stock exchanges, and
trying
so
to
on
make
and so
money.
forth. Yeah, so you can really Google our guest, and you will see a lot of knowledge and wisdom across the internet. Welcome, Louis, to Strategy and Future.
Thank you so much for having me. Thank you for the very kind introduction. Jacek, Albert, it's a pleasure to be here.
Okay, we talked to you more than a year ago. When
that long already? Wow.
Yes, when of course it was still Donald Trump who initiated the trade war, and maybe triggered the thinking about decoupling of the world economy. Where are we now in terms of the superstructure? We'll get later into details, but about superstructure. Where is the world heading now? How the markets are viewing the direction in that respect?
Well, so look, I think when we spoke, I can't believe it was already a year ago, but when we spoke, I think it was following the publication of my book, Clash of Empires, and I don't want to sound like I'm plugging it. The main thesis of the book, of course, was that Xi Jinping was a transformational president for China, and that in essence, Xi Jinping was changing China's relationship with the rest of the world because he was sort of the first president to try to project China's powers beyond China's borders. And in the book, I make the case that he's really China's first imperialist president or leader for over 500 years. Now, since then, I'll back up a little bit. The starting point of my book is looking at a world very much from a Chinese angle, partly because, that's what I've spent the past 20 years doing. I've spent the past 20 years living in Hong Kong and investing money across Asia, but mostly in China. Our firm, we manage money in Chinese equities and Chinese fixed income. So, if to a hammer everything looks like a nail, if you spend your whole day looking at China, your worldview tends to have that angle. Today, given the seat of looking at the world from a Chinese standpoint, if you wish, I would say on the one hand, not much has changed and everything has changed at the same time. The not much has changed is that the clash of empires that I referred to in the book is still very much there. I think initially, when the tensions between the U.S. and China started, the first initial reaction was that this was mostly linked to Donald Trump. And to a large extent it was. I think Donald Trump single-handedly managed to change the narrative around China and Washington, D.C. Before he came in, there wasn't much of anti-China sentiment. And by the time he left, being anti-China was probably the only bipartisan issue in the U.S. Both Democrats and Republicans are vying to see who's the most anti-China. So today, as you get a new U.S. administration, it's not obvious that this clash of empire abates. You might see some easing on things like tariffs, because the Democratic Party is now no longer as protectionist as the Republican Party is. So you might get things like this, but what started off as a trade war very quickly morphed into other things, not least of which a tech war. Basically, the United States telling the world that you can't export semiconductors to China anymore, you can't export key technologies, and really trying to take down Chinese national tech champions like Huawei and ZTE. And that is still very much there. The arrival of Biden hasn't changed anything at all in this dynamic. So that's for the part that really hasn't changed. For the part that has changed massively, of course, since we last spoke, We've had COVID all around the world. And here, what's been interesting has been the massive divergence in policy responses wherever you care to look. Now, I would say that at one extreme, you have the United States, where money printing and fiscal spending from the government has basically blown everybody else out of the water. So last year, the US government increased its debt by $13,000 per American, or $39,000 per working American. This is simply unprecedented in history. Never have you seen such a rapid increase in government debt per person anywhere. To put things in perspective, in Europe, the increase in government debt ranges typically from about $4,000 in Italy and Spain to about $6,000 in France and Germany. So the US has increased their debt by anywhere from 2 to 3 times what European countries have done. And this has been funded through an unprecedented increase in money printing. And you look at the monetary aggregates in the US, M1 is growing by over 70% year on year. This is simply never seen in a modern democracy since World War II. M2 is growing by 26% year on year. Again, simply unprecedented. In the inflationary 70s, the fastest growth rate of M2 was around 15%. So a growth rate of money such as we haven't seen before. And on the other polar opposite, you have China. Now, China, interestingly, has decided to deal with this crisis by sitting on its hands. And the reason for that is that China's export sector has actually been booming in the past year. While the Western world shut down their factories, while the Western world basically destroyed their supply lines, China kept working. And so today, China's trade surplus is running at $70 billion a month. And so you have today this sort of dislocation where China's producing like crazy and selling to the rest of the world. And at the same time, the Western world has, in essence, shut down their factory lines. But to keep consuming, we're printing a lot of money and increasing government debt. Now, there's nothing wrong per se with increasing government debt if the money you spend goes into productive assets that then allow you to pay back your government debt. Today, the COVID response, if you adjust it for inflation, is 30 times the Marshall Plan that allowed for the entire rebuilding of Europe. It's 6 times the FDR's New Deal, which allowed for the electrification of the Western and Southern United States. The big difference, of course, is that while the Marshall Plan and the New Deal funded a lot of productive investments, today's money spending in the West is just funding consumption. And so that leads me to my big fear, which is that inflation is about to accelerate big time in the West. Because one of my favorite definition of inflation is the one provided by the French economist Jacek, who said inflation is funding expenditures that give no return with money that does not exist. And that's where we are today. So today we have polar opposite policy responses: a China that's producing, a West that's consuming, and at the same time we have growing geopolitical tensions between a West that wants to shut down China. To me, this seems like a highly unstable environment.
True. We also listened to Ray Dalio, who is, in my personal opinion, also admonishing over this sort of split and the structural challenges that the U.S. is facing. But at the same time, we hear a lot of arguments among the mainstream U.S. that it's fine, monetizing is fine. It's like taxation still, as long as we have the U.S. dollar and the world has to accept everything what we're doing. We can easily swallow it. Okay, we can easily swallow it, and China is no match for us because nobody will trust the Chinese bonds because Xi Jinping can always expropriate anytime, as opposed to U.S. Of course, these are very simplistic arguments, but still, that's as you know, common wisdom, yeah, across the world. How would you answer to that?
When Napoleon came through Poland on his way to Russia, uh, his soldiers got drunk on Polish vodka, and you know, uh, and became completely useless. And of course, the Poles kept drinking, and they were fine. And this is, in French, there's an expression that says, drinking like a Pole, um, because Napoleon told his soldiers, if you're going to drink like a Pole, i.e., you can drink, but you got to be able to handle it. Now, the reason I say that is, I'm sure you guys are obviously Polish, so I'm sure you've gone drinking before. When you go drinking, you never know when you've had enough until you've had too much. You're out there, you're having a good time, you're having a drink, another one, and then you're drunk. And by the time you're drunk, it's over. And so you never know when you've had enough until you've had too much. And I would say the same is true for monetary policy. Today, we could easily say, yeah, let's have another shot of tequila. Let's have another shot of vodka. Maybe it'll work out great. Maybe we'll have a grand old time. Or maybe we'll end up drunk and passed out on the floor. And the reason I highlight this is the level of debt and liquidity injections that we're putting into the system is simply unprecedented. It is miles above what we've done in the past. Now, indeed, the idea behind it is that, well, we did some in 2008 and it wasn't that bad, so we can do more this time. And perhaps it won't be that bad. Perhaps it won't be. But what if it is? What if it, what if it is too much? If I asked you a question and I said, what do you think is the single biggest comparative advantage of the United States? It's actually funny because when I ask that question to my American clients, they always say, oh, we have the rule of law. I say, well, lots of places have the rule of law. Britain has the rule of law. France has the rule of law. We don't have like secret police that comes and drags you in the middle of the night. They say we have some of the world's best universities. I say, yeah, that's true. But, lots of places have terrific universities. I think the biggest comparative advantage, if you ask somebody outside of the US, what's the biggest comparative advantage of the United States? They'll say, oh, it's easy. They have the US dollar as the world's reserve currency. When you have the world's reserve currency, it allows you to follow whatever monetary and fiscal policy you want without any constraints. Now, the big risk for the US is, of course, to lose that comparative advantage. And I'm not saying that they will. But I am saying two things. First is that, and this was a big theme in my book, China is trying its best today to undermine the US dollar as Asia's trade and reserve currency. And that is part of China's imperial strategy. And it's the whole point of the RMB internationalization, et cetera. So that China is gunning for this. Okay, so that's the first point. The second point is, if you know that China is gunning for this, why would you at the same time do everything you can to possibly undermine your status as a reserve currency? Because let's face it, when you're growing your M1 by 71% a year, when you're adding $13,000 of debt on the back of every American just to fund consumption, not to fund any productive investments, that's exactly what you're doing. So I think what you're doing is you're playing with fire. Because if the US loses this battle, in essence, to have the world's only reserve currency, if the US loses its battle, then the US loses its massive comparative advantage. And then what the US is basically another massively over-indebted market.
Yeah, but I think it was you in the Clash of Empires that described this privilege of US dollar as something that will stay. It's very difficult to change it, like with Windows. Extremely. Again, at the same time, there are some arguments that this is the last symptoms to be gone, but the empire has been gone before that symptom is gone, right? And can you see the symptoms of that in the air somewhere?
Well, I'm sure you know the old Mark Twain quote of, how did you go bust very slowly and then very quickly? So, at the same time, I'm sure you also know Adam Smith, who said there's a lot of ruin in the nation. So, people always have nightmare scenarios, etc. But by and large, you can slide down for a really long time. Look at, I think it was an Italian finance minister who once said, when people were predicting doom for Italy, he said, it's okay, we've been slipping for 2,000 years. And yeah. So, you can slip for a long time. And, the reason I highlighted in Clash of Empires that, reserve currencies are very sticky, is that you have so much infrastructure built around them and built on them. I think in the book I used the parallel, maybe I don't, I can't remember, with Microsoft. I'm going to assume that you guys use Microsoft. Most of our clients use Microsoft. Most of the people in the financial industry use Microsoft. And, a few of us use Microsoft because we love it. But we use Microsoft because everybody else uses Microsoft. And the same is true for reserve currencies. Everybody uses the US dollar because everybody else uses the US dollar. Now, staying with the Microsoft analogy, I think if I brought you back to 2005, 2006, back then Apple was trading at 8 times earnings. And Apple was trading at 8 times earnings, and the view at the time was, yeah, Apple, they make nice niche products. It's all nice and good. But Apple will never be able to compete for the corporate IT budget of the big investment banks or the big retailers or the big businesses. General Electric, Walmart, Goldman Sachs, they'll always be on Microsoft. In 2007, Apple comes out and says, you know what? You're right. We're never going to compete for the big corporate IT budgets, so we're not even going to try. Instead, what I'm going to do is I'm going to go directly to the consumer. So they launched the smartphone, they launched the iPad, and they launched the iOS system. And in so doing, they leapfrog Microsoft. The reason I highlight this is that today people tell you, well, China can never be a proper settlement currency. The US controls the SWIFT system. China can never really break in. The US won't let it, etc. The renminbi can never be part of the operating system. China has basically come out 6 months ago and said, you know what, you're right. We're not going to try to compete by going through the banking system. We're not going to try to compete by going through the SWIFT system. We're going to compete by going straight to the consumer by launching the digital renminbi. Now, they've launched it already in a few key places in China. The big coming out party for the digital renminbi is the Winter Olympics next year in Beijing in February 2022. And by that point, basically, very quickly, what you'll see is, let's say you're businessman in Russia going to Warsaw for meetings. When he lands at the Warsaw airport, he jumps in a taxi. He'll pay for the taxi with his smartphone, with his WePay or Alipay or whatever app. He'll pay for his hotel and his restaurant with the same thing. And instead of these transactions settling in US dollars and settling through the SWIFT system, they'll settle directly through the digital renminbi. And they'll be cheaper. And in essence, in so doing, China will have created a parallel operating system to the US dollar and to SWIFT that will basically go straight to the consumer. And China can do this because it has two massive comparative advantages. The first is the size of its domestic market. Once it launches the digital RMB in earnest, you'll have 1.3 billion users like this. They'll tell everybody you have to download this, and this is how it is. So 1.3 billion users. It took Facebook 6 years to get to 500 million users, and it took them 8.5 years to get to 1 billion users. China the digital RMB will get to 1 billion users within a year. So that's the first advantage. The second advantage, of course, is that China is the world's biggest manufacturer today. And so what will happen if you're if you're you sitting in Warsaw and you think, you know what, I'm going to go on Alibaba to buy myself some new bookshelves because it's going to be cheaper than going to IKEA. I'm going to ship them in. Well, increasingly, this will only be doable through a digital RMB. So anybody who wants to trade with China and trade through Alibaba, trade through JD.com, trade through one of those massive platforms that more and more people around the world are using, all that trade will be in digital renminbi. And so that's today the big threat for the United States is just like Apple created a parallel operating system with the smartphone that it ended up owning, China is doing the same thing with the digital renminbi.
Louis, from what you're saying, at least I imply, or at least I gather, that it's not true what some strategists across U.S. are saying, that the U.S. is so great and is an independent island, they can withdraw, and based on their domestic market and so on, and the U.S. dollar will survive anyway, because that means that if they don't compete in Eurasia and elsewhere in markets and regulations and all the SWIFT banking systems, they can simply be replaced. So, and at the same time, because of their debt and the external investors that need to invest, the US is in deadlock. It cannot simply reconsolidate by cutting the overstretched commitments in Eurasia. Am I reading right what you're implying in terms of?
No, look, I think the U.S. does have choices. One of them is the choice to withdraw. But basically, the choice to withdraw and come back on its borders, stop being an empire, stop being the world's major reserve currency, etc., means that all of a sudden you lose the advantages of empire. Basically, the ability to consume a whole lot more than you produce year in, year out. The U.S. has run massive twin deficits over 5% of GDP for basically 20 years running now. And a lot of these deficits are funded by foreigners because foreigners are happy to keep U.S. dollars in reserves. Now, this ability to keep, if the U.S. says, you know what, let's just withdraw, let's just come home. In essence, what you're saying is, let's stop consuming more than we produce. Let's stop running twin deficits of 5%. Now, inherently, this implies a massive weaker dollar. And what it means is a massive shift from the U.S. consumer to the U.S. producer. For the past 30 years, the best thing to be in the world has been a U.S. consumer. You got to consume the labors of the world, and all you had to do was print money to do it. This is the part that changes. So, if you think, okay, the U.S. is going to withdraw, then what you do is you buy the U.S. producers and you sell the U.S. consumers. You don't want to be long Walmart. You don't want to be long Home Depot. You don't want to be long Tiffany and Amazon. You might want to still be long Caterpillar or Ford. There's always different ways to make money in financial markets, right? You just have to be on the right side of the correct trends. The trend that you describe, where the U.S. withdraws, is a trend where the U.S. dollar goes down, which is great news for most emerging markets, great news for commodity producers, and it's a trend where I think inflation runs structurally much higher, and so it's terrible news for bonds, but it might be very good news for other assets in the U.S.
Yeah, but that will just, I think that this will break down the social contract that the US is having right now, right? I mean, that will have to completely change the society and how it works.
Well, I think when you've used people for 30 years to consume more than they produce, and now you tell them, look, party's over, you have to produce more than you consume, it's bound to go down like a lead balloon. I don't think people will be that excited about it. But what's the alternative fundamentally? Now that China's making this move, now that basically China is revaluing the renminbi as we speak. It's been now the strongest currency for the past 12 months, for the past 3 years, for the past 5 years, for the past 10 years. Now that China's on this path to structurally let the renminbi go up, and internationalize its currency to challenge the U.S. dollar. Now that that's done, there's two choices for the U.S. They can accept it. They can try. Well, actually, there's a few choices. They can accept it and basically retrench. And yes, to your point, it makes for a different social contract. They can try to fight China head on and basically say, you know what, we're going to have tremendous productivity gains. So let's invest to have tremendous productivity gains. And I think that's what Biden is going to try to do with his new infrastructure plan, et cetera. But the big question is then, is he successful or is he just wasting money? We'll have to see where the investments go. For now, however, all the stimulus money, et cetera, none of it has gone into investment so far. So you keep digging yourself a bigger and bigger hole. And so the third option is you take China down any way you can. And
exactly.
I think that's what Trump was trying to do, right? It's like, okay, China's getting better than us at telecoms. Let's block their telecom industry. I think that's where and that's potentially the third option is provoke the clash.
And but before I give the floor to Albert, he has a few questions. Yes, on this side of this aggressive stance that Trump initiated, do you think it's conceivable to see the following situation, that the U.S. understands that it stands on the edge of the chasm, and they only have this option to take China down? And I'm not talking about the kinetic conflict, which is always a possibility, but and I heard that there were some hawks in D.C. and late Trump thinking that Wuhan virus, let's issue the invoice because we suffer from their virus and it's like in trillions, so they need to pay compensation. And of course they will not do it, so we will we'll offset the with with the payments for U.S. treasuries or something, and we'll say then we are square. Do you think it's conceivable that there might be some thoughts like that across Washington, or
I think there's definitely some thoughts like that across Washington. I think there's definitely some thoughts like that across Washington. Now, whether it goes ahead,
and how the investors would react worldwide,
Well, I was about to say, I think if the U.S. went down this path of saying, look, here's the bill, and until you pay us, we're going to confiscate your treasuries and confiscate Chinese assets in the U.S. I think that would seal the doom for the U.S. That'd be cutting your nose to spite your face as far as the U.S. is concerned. It'd be cutting your nose to spite your face because what you're doing is basically undermining one of the key reasons foreigners put money in the U.S. is this belief that you have sacrosanct right of property, right? I mean, the reason people invest in the U.S. is this belief that nobody can steal my money because there's an independent court system, because this, because that. So if the U.S. government unilaterally, said, we're taking your money, first, it would lead to court cases. The U.S. is still a law-based and a rules-based society. So China would say, okay, we'll see you in court. Now, the U.S. would have to prove that, the virus came out of China when, maybe it did, maybe it didn't. There were early cases in Iran. There were early cases in Italy. They would have to prove that it came out of the Wuhan lab, et cetera, beyond a shadow of a doubt, because that's the standards that we're held to in Western courts, thankfully. So I think it'd be highly unlikely that the courts would convict, actually. And if the courts did convict, I think it would, then a lot of other foreigners would say, hold on, do I really want to keep assets in the United States? So it could actually precipitate a collapse in the US dollar, because all the foreigners that own a ton of assets in the US would say, you know what, I'm out. So if the US went down this path, it could actually end up accelerating the demise of the US dollar as a reserve currency. So I think it would be a really silly path to go down. It doesn't mean they might not try. I'm not saying that these conversations aren't going on. I'm sure they are. I think it'd be really silly, though. And if it did, I would be a big seller of the US dollar.
You would. Albert, pardon me, I need to finish this particular detailed question because that's my nightmare. I think it's quite probable given the structural split. But don't you think that when I was seeing the face of Trump, And it's not that I didn't like him. I mean, it doesn't matter whether I like him or not. And Navarro, I saw in his face that he contemplated that. And he would say, you know what? They would be complaining for 2 weeks and they would come back with their money anyway, because where would they go if it's not the US global power projection? Anyway, it's only US that they could invest. There is no other place. China? No.
So it's actually, I think we're about to see the answer to your question in real life. As things stand today, there's roughly $20 billion a month, $20 billion US dollars a month coming into the Chinese bond market. And foreign money is meanwhile leaving the US Treasury market. Why? Well, you have minus 2% real in the US, you have plus 1% real in China. Most investors are yield hogs. They want yield. And today, one of the few places you can find yield is China. So, Trump, like this point by Trump, they'll come back in 2 weeks, etc. It might have been true a few years ago. I don't know if it's still true today. A lot has happened in the past year with, lockdowns, riots in Washington, riots in Seattle, riots in Portland. The idea that the U.S. is this end-all, be-all, it's taken a bit of a knock. And then, in any event, Trump is now gone. So whatever Trump thinks probably doesn't matter as much now, and it's what Biden thinks. And here, that's another, I think, big question mark is what kind of I don't know if you watched this press conference a week ago. I think there's this genuine concerns of Biden's cognitive abilities, right? And his is this the guy that's going to lead a big upending of property rules in the United States, or is he a guy that's just trying to keep things together? He strikes me as the guy that's just trying to keep things together, both for himself and his country. So Trump is gone. It's now Biden. Biden likes to talk tough, but I don't see him nearly as confrontational as Trump.
Albert?
Yes, you basically killed my question because I was about to ask. It's that now. I wanted to ask about your famous the analogy you bring up often about rugby players and the ones we don't have rugby around these parts, but
you should. You have big guys in Poland.
It's not a bad idea, but about the offensive linebackers in like U.S. football terms, being the U.S. Treasury bonds and some safe haven. If you don't want to invest in risky equities, this is what you turn to. And that was this disastrous auction, right, in late February, I think, vis-a-vis what you said about Chinese government bonds and this being unique and this showing that money is basically moving away, right, from the U.S.
So look, the analogy I use with rugby, but you're right, you can use it with American football as well. I said a properly built portfolio is a little bit like a sports team where you need people of different shapes and sizes. A rugby team is quite unique in that you need some short, fat guys, you need some tall, lanky guys, you need some guys who can like run forever, like marathoners. You need guys who can run sprints. So you need guys, all sorts of different types of guys to make a full team. And yes, I use that to describe how a portfolio is, because if you want a portfolio that withstands shocks, you need things with different attributes. Now, for me, the offensive lineman, in essence, of your portfolio, or your prop of your portfolio, has always been U.S. Treasuries. U.S. Treasuries in tough times always came through for you. If ever, for whatever reason, you had a big hit, whether an endogenous shock or an exogenous shock, something that comes out of the blue, like let's say Fukushima in 2011, something unpredictable. U.S. Treasuries do very well. So that's why people had them. However, look at the past year. In the past year, you've had different events, and U.S. Treasuries have basically stopped acting well in the face of these bad events. The first one, of course, was the market shutdown in March 2020. U.S. Treasuries initially rallied, and then they crashed. That was the first time in my career where at the same time I had an equity market crash and a bond market crash, and losing money on both sides. So all of a sudden, you know, when things go bad, you expect your equities to go down. You don't expect your bonds to go down. So I look at my bonds. I'm like, hey, what are you guys doing? You're supposed to be saving me, and you're hurting me. Or look just at the past week. There's been all this news about Bill Wong and Archegos hedge fund blowing up. Right, this guy who was over levered, and he had concentrated positions, and because he was over levered, he couldn't make his margin calls, and then all of a sudden, investment banks had to fire sell his stock positions, and so you had big stocks like Viacom, like Discovery Channel, losing all of a sudden 50% in just like a couple sessions. These things got crushed. Now, historically, when a hedge fund blows up, like LTCM in 1998, U.S. Treasuries rally. Like usually, there's a sort of rush to for safety in markets. Bad news, I rush for safety. I'll buy U.S. Treasuries. Here, this is bad news. You know, this hedge fund blowing up means that regulators are going to come down on investment banks. Investment banks are going to have to cut down their leverage. People are going to, you know, get margin calls all over the place. You know, this is not a good news. And yet, U.S. Treasury yields continue to move up. You know, yesterday they're back at 175. They continue to creep higher. So, you know, I come back to this is if U.S. Treasuries, you know, if we have a hedge fund blow up and U.S. Treasuries can't rally, then that just raises the hurdle. It means that to get a U.S. Treasury rally from now, you really need a massive event. You need something really big, something bigger than just a hedge fund blowing up, something bigger than Nomura losing $2 billion, Credit Suisse losing $2 billion. I mean, that's proper money, right? You know, the Credit Suisse and Nomura share prices were down 15%. You know, these are big hits. So, and yet U.S. Treasuries did not rally. That to me is a very telling sign that the U.S. Treasury market today is different or is changing from what we've known for the past 20 years.
So from sort of naive perspective, those two things happening and those treasury yields being so disastrous and those auctions is a terribly bearish sign long term for the United States, right?
Well, so I think it is. Let me look at it a different way. The Fed has told us I'm going to buy $120 billion of treasuries every month, right? In February, they bought $180 billion, 180. In March, we don't have the final numbers for March yet, but 3 weeks into March, they'd already bought $137 billion. So it probably looks like for March, they'll probably do another $180 billion or so on current projections. So that'll be 2 months in a row where they'll have bought 50% more than they said they would, right? And even though they went out and they bought $180 billion a month, U.S. bonds are still falling, right? So here's this new player coming in. I'm putting $180 billion on the table. Well, saying I'm going to put 120. In fact, they put 180, and yet the price still falls. It tells you, I think, the imbalance there is in the treasury market today is that in spite of the intervention of the Fed, in spite of the fact that the Fed is out there hoovering it, it still can't make the price go up. So, and the reason is simple enough. The amount of issuance coming from the U.S. government is just nuts. It's just crazy. And rather than rate it in, the U.S. government is saying we're going to do even more. You know, it's like we just did 1.9 trillion, but let's do another 2.5 trillion. So instead of reining it in, you know, it's like, yeah, let's go all in. And so, yeah, I think the U.S. Treasury market is sick. And until you see a change in either monetary policy or fiscal policy, I think the market will stay sick.
So this is what you spoke of as spiking the punch bowl, right? Ad infinitum with more and more, 200 proof alcohol, basically, because you cannot stop. Is it even possible? Because early, when the dollar deflated early in the pandemic, right, they were hoping for inflation, because that would, move the economy again, But now, they seem to be, or they will be getting more than they ever asked for. And is there a way to even stop it, to taper off that?
I don't think there is. I don't think there is. When you look at, the reality is, when you look at U.S. government spending today, where, more than 100% of tax receipts now goes to fund the defense, the interest payments on the debt, and the what I would call the social transfers. Your Medicare, Medicaid, etc. Things that, by and large, are very hard to cut. And so before, the U.S. government, and when you look at U.S. tax receipts, 100% of tax receipts goes for that. So that means that, before the U.S. has even paid for the maintenance of the roads, or paid for new infrastructure, or paid for the schools, or paid anything, the money's already gone. So, the big question is, who continues to fund the U.S.? Is it the U.S. private sector? Is it foreigners? Or is it the Fed? Now, what we're finding out is that already foreigners and the U.S. private sectors aren't enough. It's not enough, because even with the Fed buying $180 billion a month, the prices are going down. So no, I think the Fed is stuck. I don't think the Fed can claw its way back. And it's stuck at a time when oil prices are rising, food prices are rising, car prices are rising, and car inventories are at record lows in the U.S. House prices are rising, and house inventories are at record lows in the U.S. You have massive supply chain disruptions in pretty much all industries. You have massive shortage of semiconductors. I look at this and I think, if you don't worry about inflation now, when are you going to worry about inflation? All the signs are there. And yeah, so, the Fed wants higher inflation. Well, the old story, you've got to be careful what you wish for, because you might get it good and hard.
We ask all those questions, Louis, not of, as you realize, not only for the sake of good or bad investment, we are not a Strategy and Future. We do not advise financial, sectors, but we care about the balance of power. This ancient concept of balance of power, and what you're saying sounds like a doomsday. I mean, the doomsday is coming.
I'm not sure it's a doomsday. But it's a change in the balance of power. Now, changes in I would say, the U.S., it's obviously been the imperial power for 70 years, and especially the past 20 since the collapse of the Berlin Wall. But the U.S. is not a natural imperial power, right? It's not. They're not. It's not like the U.S. It's not like France and Britain, where we had imperial schools and we were training administrators to go be, administrators in the colonies, etc. And the end of our empires was lived very poorly, and perhaps less so in Britain, but even then. But in France, it was lived very poorly, and it led, to the end of the Fourth Republic, the start of the Fifth Republic. Losing your empire is always tough. But, Europe went through it. Europe lost their empires. France and Britain really were the two big imperial powers. We lost our empires, and we learned to live being smaller countries. And here, Britain is perhaps the best example. Britain lost its empire, learned to be a small country, or a smaller country.
Did they? By the way, did they really learn to be a small country? I mean,
a small country. I think they did, and they had a very tough 1970s, right, where they ended up with the IMF in Britain, and they had very high inflation, and it was a big, big loss of power for the consumer, and then they had to reinvent themselves, and they did reinvent themselves. And the U.S. has reinvented itself many times. It has some of the world's best universities. I think it can easily, lose its empire or its imperial privilege, but still be a very prosperous nation. But the period of adaptation may not be very fun.
Yeah, Louis, for a Frenchman, you really went very easy on the British. There was, I must tip my hat to that. But I wanted to ask you also if I don't know if we could and this is the moment I get booed for being a sensationalist. But and also the problem I guess with the US is that they don't have the social cohesiveness of the UK, right? This would be another problem if they go the way of Britain, because this is, again, I heard it from somebody else this way, exactly say that this decline will remind you of Great Britain. But I also wanted to ask you, and this is where I get booed for being a sensationalist. You said something incredible would have to happen to drive the interest of the U.S. Treasury yields or bonds again, to make people interested with that. Would a war be one of those things? Possibly?
Oh, for sure. Yeah, for sure. If that'd be one of those things for sure. But then again, wars are costly business.
Unless you win, and you can just
yeah. It might or it might not, to be honest. If you going back to the reason I went easy on the Brits is it's stones and glass houses and all that, right? It's if you're French and you talk about decline of managing your imperial decline, I'm not sure that France did a whole lot better than Britain. But if you go back to Britain, they won World War I, they won World War II, and it sacrificed sterling as a reserve currency, and it sacrificed the gilt market. So if you go back to the pre-World War I, you might have thought, okay, well, Britain needs to take down Germany now, because if they don't take down Germany, they're done for. As basically being the lead European power. So they did take down Germany in World War I, but really it was a Pyrrhic victory, right? It destroyed Britain as well, and the pound never really recovered. Well, they tried to make it recover. That led to a depression in the 1920s, etc. Which actually brings me just to another side point. One of the things you hear today everywhere is that we're set for another roaring 20s. At least in the US, that's the big, we're set for a roaring 20s. Because the US in the 1920s did have a massive boom. Now, why did it have a massive boom? Because it basically picked up all of Europe's gold and all of Europe's wealth because of World War I. World War I was Europe's long suicide, and all the wealth moved to the United States. If we think, okay, COVID is like a war today, who wins, who loses? Well, right now, who's getting all the wealth? China's running 70 billion trade surpluses. Now, Europe did not have a roaring 20s. Germany had hyperinflation during the 1920s. Germany, the entire middle class was completely wiped out, and upper class, where everybody was wiped out in Germany during the 1920s. Which planted the seeds for fascism, etc. Britain had an enormous depression in the 1920s as it tried to keep sterling a reserve currency. The U.S. had the Roaring 20s, but that was it. So if we think, okay, who's going to have the Roaring 20s now? Is the U.S. going to be the U.S. again, or is China going to be the U.S. this time? And if China is going to be the U.S. because they're capturing all this wealth during COVID, just like the U.S. captured all the wealth during World War I because they were the ones running the big trade surpluses. Today, China's the one running the big trade surpluses. If China's going to have the Roaring 20s, where does that leave the U.S.? Does that mean that the U.S. is Weimar Germany? If you want to be sensationalist.
Nicely put, Louis. Nicely put. And because we beautifully ventured into the future of Europe, and that. So, what is your take on that? To the future of Europe. What?
I know. Is there one?
I see. Okay, so exactly. What do you think? At the end of the day, your interlocutors are situated in Europe now. What do you think about it? Between the clash of empires in this, poor demography, export-oriented markets with German, increasing role, the rift between France and Germany, south of Europe completely devastated. What would you say?
So I think if you look at the end of World War I, it killed every empire out there. It killed the Romanovs. It killed the Austro-Hungarian Empire. It killed Kaiser Wilhelm. It killed the Ottoman Empire. It killed it basically finished off the Qings in China. You came out of World War I, and every empire was gone. And the reason for that is, I think wars obviously stretch your social fabric to the maximum, number one. And number two, multi-ethnic, multicultural, multilingual empires are tough to hold together anyway. Now, for me, the EU is, of course, the modern day empire. It's multi-ethnic, it's multicultural, it's multilingual. It's this European dream that comes up every 100 years, Napoleon, Hitler, etc., to tie everybody in Europe together, because we have a common culture to some extent, common Christian culture, common civilization. But at the same time, we also have very strong differences. Now, if I highlight this because for me, COVID is like a war. It has had the economic impact of a war. Now, fortunately, it hasn't had the human impact of a war. We haven't lost that many people, and most of the people we've lost haven't been young people, which is typically what you lose in a war, but it's old people. But it's had similar impact in that, birth rates are collapsing everywhere. You would think people would be stuck at home, they'd have more babies, but it's not happening. Because of the uncertainty, people are having less babies. So that's like the same impact as a war. Natality always collapses during wars. Now, if you look at COVID and you think of it as a war, then okay, COVID has had the economic impact and the social impact of a war to some extent. Who wins and who loses this war? Now, you could say nobody wins, but there's definitely some people who lose more than others. Now, I would say Europe today is amongst the biggest losers. The European Union has been completely useless at rolling out vaccines. It's been completely useless at mandating common policies across the zone. It's basically, as soon as trouble started, everybody pulled their covers to themselves. So Italy shut down, and then Denmark shut down against all European rules. You're not supposed to shut your borders, but they did it anyway. Everybody went on their own. How'd you claw yourself back from that? Through this crisis, we've just had a massive crisis. What has been the value added of the European Union through this crisis? I would say the value added of the European Union has been massively negative. So I think you have to question whether the European Union survives this. I really do. And already you're seeing Hungary saying, "Screw you guys, I'm going to go with the Chinese vaccine because they're giving it to me and I need vaccines." Everybody's going their own way. How do you pull everybody back together? So if you think that wars are typically the straw that break the back of the camels of empires, for me, the European Union is, it's on a death watch.
Especially especially since the veneer of professionalism and technocracy around the elite in Brussels, right? Which was completely stripped of its legitimacy.
Well, the big argument for the EU was that we were stronger together than alone. That was the first big argument. This has proven not to be true. The second big argument was the argument of competency. Was we're in essence outsourcing policies to guys in Brussels, to technocrats in Brussels who are highly competent. And this has also turned out to not be true. So then, it's like, okay, so what do I pay these guys for? What's the point?
But if that happens, so all scenarios are possible. What do you think about this scenario for Europe? And, at the end of the day, you're also, I understand French.
I am, very much so.
Yeah, so, it's still a place dear to our hearts, I've been thinking recently, so I admit to something openly, that if Europe doesn't sort of understand the situation it is now and doesn't consolidate somehow, but it's still very difficult to do it. I don't know how they would do it. they might face the fate that China in the 19th century faced. No technology advancement, no new cycles of technology, no markets in this new geopolitical world of competing empires, no demography, a full feeling that we are the best in the world because we are so cultural, right? And now and foreign empires penetrating, Russia from the east, the Turks from Levant, Americans penetrating from the Atlantic politically, and it's going to be like a medieval ages in terms of the political dislocation.
I fear you're right. I fear you're right. I think the outlook for Europe is a challenging one. It's a very challenging one.
And do you think that in France, you're French, when you see the debate in France, do you see that they realize the moment that this is the hour of sort of truth, and there is some sort of understanding where we are as Europe, as the world? How would you assess that?
I think people definitely do, and that was part of Macron's election, right? Hollande was elected, and by and large, he was perceived by most French guys as not being very smart, and he got in there on a bit of a fluke, etc. People were tired of Sarkozy's corruption, and then Strauss-Kahn imploded, so he sort of snuck in there. And then Macron came in basically on the promise of competence. Macron came in and said, vote for me, and we're going to have the best technocrats. And he came in on the promise of competence. And the problem with Macron, I think, was that he was deeply, deeply insecure. So he actually built a government around himself of half-wits, so that nobody could, put shade on him. He kept finding prime ministers that nobody knew about, picking ministers that nobody knew about. And instead of, getting all the best and the brightest in the land, he got a bunch of people that would never challenge him, which actually shows that Macron is actually really stupid. Because that's what stupid people do in an organization, right? They hire people that are dumber than them so that those people never shade them, which is, while very smart people always want to hire people that are much smarter than them. So now we've had, in essence, 10 years of complete lack of leadership. And no, I think, which brings you to the coming elections. And, the IRA used to say, they kept trying to kill Margaret Thatcher. They kept trying to kill members of the British cabinet. And they would say, when they would fail, they'd say, we failed this time, but we only need to get lucky once. To stop us, you need to get lucky every time. When I look at France and Italy today, with the anti-Euro feeling growing, basically the feeling that we keep voting for these technocrats, but they turn out to be incompetent, and this has been really highlighted with COVID. The anti-Euro camp only needs to get lucky once. They need to get, just as we saw with Brexit, and then the entire European empire implodes. And I don't know if it comes from Italy or if it comes from France, but I think it's going to come at some point. Some anti-Euro guy, whether it's Le Pen in France or Salvini in Italy, gets elected, and that's the end. That's the end of the European empire. They only need to get lucky once. And when you look at the incompetence that has been shown by Brussels technocrat, by Parisian technocrats over the past few years, I don't think we're far off.
Louis, is it okay? Louis, the way you characterize Macron is very similar to the way you characterize French elites in your recent podcast. And when you did a little tournée around Europe describing, the Spaniards, the Italians, and so on. And it was brilliant. But the one I really paid attention to, and it really fit what we observed at Strategy&Future with Jacek, is the German elite. That was made up of the industrialists, and they are the people that really drive the overall direction, I guess, of the German foreign policy to an extent as well. And I've seen this when the German automotive industry just demanded, Heiko Maas or whoever does something about semiconductors, because this isn't funny anymore. And you've also seen this with the investment agreement with China.
Yep.
And I wanted to ask you about this as well as the other pact, the RCEP that China signed, as the way that China, as a kind of segue into question how China will interact with Europe in the coming years.
So, like, I tend to believe that whoever holds the most economic power tends to have big sway in policies, and typically does policies that favor them. So you mentioned the power of the German auto lobby. I don't think it's a surprise that Germany is pretty much the only country in the world where there are no speed limits on the motorways, and where also Germany is one of the few countries in the world that doesn't publish its deaths on the motorways, because obviously it's your German auto lobby is very happy for you, to say, hey, buy this really, really powerful car and go drive it at 250 kilometers an hour. Because otherwise, what's the point of buying a really powerful car? Each countries will have different lobbies that matter more than others. And yes, the German auto lobby is very important. And today's biggest auto market is China, which means that Germany has to get on with China. There is no other choice. It's too important a market. And so yes, I think two big events have occurred in the end of last year, which most people, because we're so focused on COVID and everything unfolding, most people sort of didn't pay attention to that. But one of them was, of course, the European-Chinese trade deal, which was Merkel's big push. She wanted to get it done before she passed on the leadership of the EU, and she did get it done because it matters a ton to German industry. And the other was the 14-country trade deal that China signed with a bunch of Asian countries, including a number of American allies like Japan, like South Korea, like Australia. This will now be the biggest free trade area in the world, in terms of economic weight and in terms of the number of people. It's absolutely massive. And so I think, these two events show that for all of America's attempts to box China in, China's not doing too badly. 10 years ago, my belief was that one of the big stumbling blocks for China is that China really didn't have a diplomatic corps. It didn't have a diplomatic corps because in China, if you were a very smart guy and you went to Beida, etc., you didn't go into diplomacy. You went to the Ministry of Finance or the central bank or the planning commission, or diplomacy was a backwater. Like, nobody cared about diplomacy in China. Unlike, say, in most European countries, right? Diplomacy is usually right at the top of government position. Not so in China. But this has changed in the past 10 years. Obviously, they now have decent diplomats if they're managing to sign those deals. So I think that's another very important shift, that if China really starts having a genuine diplomatic corps that can do deals, push agreements through important countries, that's another, important piece of our world that is evolving.
Mm-hmm. But building on that, what would you do if you were your Australian Prime Minister, being squeezed between the market supply and demand thing with China and the U.S. pressure? How would you steer? How would you navigate? And
I try to do like New Zealand and keep as low profile as possible. Mm-hmm. But it's not very obvious. If you're Australia today. If you're Canada today, you're in essence stuck in the middle of a fight between two big dogs. When you see two huge dogs fighting, usually you don't want to be a part of it, right? When you see, Muhammad Ali and George Foreman going at it in the ring, your natural inclination is not to say, "Well, I'm going to jump in this ring." Your natural inclination is to say, "I'm going to sit on the sideline and see how this goes." This is where we are today. It's a George Foreman versus Muhammad Ali fight. as much as possible, you want to try to avoid getting in the ring.
And my last question, I don't know how about you, Albert, but my last question, in the book, you were, I think, warning the U.S. decision makers against choosing the battlefield of technology and this Azincourt, right, or Crécy battle. So.
Good memory.
Yeah, I like this, of course, this comparison. What is the center of gravity today? Where would be the fight?
Here's an interesting bit, right? So 4 years ago, the U.S. decided to put the stage of the battlefield, move it from a trade war to being a tech war. It was in the summer of 2017 that the U.S. Said, we're not going to export, we're going to block ZTE from getting semiconductors. And then a year later, they blocked Huawei. So they put the battle onto the semiconductors. Fast forward to today, and what do you find? You find that there's massive global massive shortage around the world of semiconductors. Why? Well, it's not that hard to think, right? If China was the biggest consumer of semiconductors in the world, if the U.S. tells all the companies you can't sell to China anymore, are you going to invest, to produce more? You're probably going to say, okay, I'm going to hold up on new investments, right? I'm going to wait and see because I don't want to produce stuff and then not be able to sell it. And so lo and behold, now, it's the law of unintended consequences. You ban exports to China, and next thing you know, you've got a massive shortage on your hand. Now, what does the shortage on your hand imply? Well, Ford has just come out a few weeks ago and said, we're going to be, we have to stop production, which means we're going to be short 650,000 F-150 pickup trucks this year. 650,000. That's a massive shortage. The F-150 pickup truck is the most sold car in America. So now, the price of secondhand F-150s is going through the roof. So it's always these law of unintended consequences. You pull a string, you never know what happens. I think what happened is the U.S. has triggered now a shortage of semiconductors, which is creating supply chain disruptions, which will create inflation domestically in the U.S. and around the world. Meanwhile, inflation is the one thing that really you can't really have if you're running massive budget deficits, because that means that your cost of funding is going to go up. So it's, the big question is the U.S., basically cutting the branch on which it's sitting by disrupting the system in this way.
Can I, just the final one. I know we're running on quite a while now. I really wanted to ask you about this dual circulation plan that Xi unveiled last year in May. What's your take on this? Or maybe even a bit earlier. How do you see this? Do you see them as turning inwards? Do you see them as like this secondary, more sophisticated growth rather than, just being a manufacturing base for the entire world? How do you see this? Is this a gimmick?
Well, I think, it goes hand in hand with what she's been trying to do since he arrived, right? It's all part of the same framework and rhetoric, and it really goes back to sort of China looking at itself post 2008 crisis. The 2008 crisis, up until the 2008 crisis, China was basically happy being the manufacturer for the world, right? That was creating jobs, it was allowing China to progress, etc. And then from one day to the next, Chinese trade fell like a rock, and 30 million manufacturing workers lost their job, literally almost overnight. And if you're a Chinese leader, you're first and foremost in the game of social stability. So as 30 million people lose their jobs, you panic. You think, we don't want these guys to riot. So China goes and does a massive infrastructure spending bill, building roads and railways and lots of things to give work to all these guys. But at the same time, I think China thought, we can't have that happen again. Now, one of the reasons things collapsed so quickly was China's dependence on the willingness and ability of American banks to fund their growth. All of Chinese growth was funded in US dollars. So that's when basically the internationalization of the renminbi starts. They say, okay, we got to stop doing that. At the same time, the whole idea of let's be 100% dependent on the Western consumer also fell apart because Chinese leaders realize, okay, the Western consumer is now getting more and more over-levered, and therefore more, the more leverage you have, the more fragile you are, right? This is what Bill Wong just found out. The more, if you have too much leverage, you can blow yourself up, and this is what we found out with the U.S. consumer in 2008. So yeah, you needed, to build avenues of growth elsewhere. The avenues of growth were grow into emerging markets and tie in other emerging markets to your own economic heartbeat. So that's the One Belt, One Road, the Silk Road Fund, the Asia Infrastructure Investment Bank, and all that. It's growing the domestic consumer. So, I think all that just continues going in the same direction.
Okay, Louis, that has been a fascinating conversation
much, guys.
with you. Okay, to our viewers, as you have seen and heard, that was a really fascinating interview. I lost track of time, Louis. Pardon me for that. That was really great. Thank you very much. Our guest was Louis-Vincent Gave, Gavekal, and Albert Świdziński, Jacek Bartosiak. Stay tuned to Strategy and Future. See you in the future. Take care.
Thank you very much, guys.
Thank
Good
you,
to see you.